Hello, we're going to show the input data to the B2T engine on intercompany transaction eliminations, and we're going to briefly explain the output tax effects of those eliminations. We know that on the consolidated financial book of an entity group, those transactions between the entities in the same group or the intercompany transactions are generally eliminated. The elimination impacts the account balances of the consolidated book. Those eliminated transactions may have their corresponding tax effects. These tax effects may not be eliminated along with their source transactions, and they may remain on the consolidated book, sometimes in separate deferred tax accounts. The processing logic is not very straightforward, but the B2T engine will handle that automatically as long as the user maps its accounts to the standard accounts and enters the elimination entries alongside the relevant trial balances. We're going to use a simple two-entity example where there are transactions between the two ought to be eliminated. We're going to show how to prepare the elimination entries in the input file and to show their tax effects. So here is our simple example. We're going to calculate taxes for a U.S. company P that has a revenue of $1,000. And since elimination is about calculation of transactions in an entity group, so we also tell the engine that there is an entity group that is led by the company P. And we further tell the engine that we wanted to calculate taxes for this group. Now, this calculation would trigger the elimination process. So in this group, we have only one entity P. Now, let's assume that we have a child entity of the P in it. So now we have two entities, P and its child, and we further needs to tell the engine that P is the parent of the child and owns the child CH1 100%. So we added an entity group relationship record to tell the engine that P owns CH1 100%. Now let's go to that recurring input, and we're going to simply assume that the CH1 does not have any revenue. And for our purposes of this demo, we're going to say that the revenue of P is all from its transaction with CH1. So this is an intercompany transaction, and so therefore it needs to be eliminated. So here we tell the engine in the elim balance, we're going to say $1,000 is to reverse the $1,000 revenue of the P. So you look, it's eliminated. Notice here that now as a whole group, there is actually no revenue. So the income is actually zero. Now let's see what happens when we calculate the taxes for the whole group. Let's pay attention to the taxes of the whole group. So we're going to save it. And we're going to submit to the B2T engine. And the engine is starting code, so it may take a few seconds. So it's done. Let's go to the output file. So here's a calculation. We see the engine did a two provision calculation, one for P, one for its child. And the child has no income, therefore no taxes. The parent has 1,000 income on its own, and it has a tax expense 210 at 21%. Now here is a composite provision summary, which is calculating the total tax for the whole group. And we know that as a group, there is really no income because the income was eliminated. However, there is still a 210 total tax on the group. So why is that? And apparently the engine says these two numbers add together is your tax expense for the group, even though there is no income for the group. So let's go to that P's provision sheet and pay attention to the elimination calculation part of the result. So we have a revenue account, okay? And we have that ending balance. We have no book to tax adjustments. But on the elimination side, we see we have an elim balance to cancel, to undo the intercompany transaction, okay? And because of the fact the P is filing separate tax returns, as a group, there is no elimination entity. So therefore, the book balance, the tax balance on the elimination entity is zero. It does not change. But for book, you have debit $1,000. So therefore, the book to tax adjustments on the elimination entity is to undo that. So you undo that, and how its elimination tax journal entry is nothing over there. And then let's take a look at the notes over here. The engine essentially says the eliminated income is reversed, but tax effects is not reversed. And here is a detailed ID for that specific rule that was in effect in this case. So that's why the income was reversed, but the engine decided that there's no elimination effects. So therefore, the book income, if we go back to the output summary, the book income of the group is simply the summation of the individual separate return provision calculation, but the elimination for the group calculation, there is really not there, okay? Now, this is not always the case. Sometimes the elimination entries will have its own tax effects on the consolidated book. For example, if the intercompany transaction involves one company sells the inventory to another company in the same group. Okay, so let's see that P has $100 inventory and sold to CH1 for $150. So therefore, P makes a profit of $50 and incurs some taxes at 21%, $10.5. This transaction is all within the same group. So that inventory transfer within the group should be eliminated. How the engine would be handling the tax effects of that 10.5 taxes that a P has to pay. So let's see. So we're going to close the output file, and we're not going to save it. And here's our input file again. And we're going to add more entries into our input file to say the fact that P is selling stuff to its child entity. So we have added a few trial balances records for our input file. A first set of records, we say we need to record that P sold $100 inventory to CH1. So on P's book, there would be cash and sales revenue and the cost of goods sold and inventory account that will be impacted. And here's a journal entry, okay? The inventory was moved out $100 into the expense, and it has a revenue of $150. And on the child's book, it simply has now $150 inventory now showed up on CH1's book. Now, because it's within the same entity group, this transaction needs to be reversed for the consolidation purposes. So the elimination entry for this transaction is to reverse this transaction that happened during the period. So in the elimination fields, we're going to add more data to reverse those transactions. So now here the original book transaction is all reversed by the entries in the elimination balance field. So we also further needs to tell the engine what exactly are those accounts, the cash and inventory and so on. We need to tell the engine by adding additional account mapping records in the setup input sheet. So here are the additional account mapping records. The engine would know cash really means the standard cash account, cost of goods sold, inventory, and so on. So that's it. We're going to save it, and we're going to submit it to the engine. And let's pay attention to the tax effects of those elimination entries. So we're going to submit it. So it's done. Let's open the output file. Now, let's look at the P on its single provision calculation just by itself. It now has $1,050 income. Remember, we earned $50 from selling the inventory to its child. And the child, again, has nothing, no income, no taxes. Now, as a group, the total tax expense now is 210, which is different from it. It's no longer the summation of these two numbers anymore. And the reason is here is an elimination of $10.50. And then more importantly, look at the journal entry here over here. The effects of the elimination entries of both is in fact reclassed deferred tax at DTA into deferred tax accounts and reclass the current tax expense into deferred tax. So therefore, the tax expense was moved out of the income statement. So there are entries such that it moved part of the tax effects of the individual book out of the consolidated book because of the consolidation. So let's take a look again, go to the specific calculation. This is the single calculation. For P, we see all the accounts. And here's our elimination. And again, the book to tax adjustment for those elimination is simply to undo because it files single separate tax return. There was no elimination entity at the consolidated level at all. So therefore, it's all reversed back. And because of that, we see the elimination tax journal entries are to moving things around. It had a tax expense that it would be moved out, okay, 150, and it had a tax, it moves around. And for each account, there are specific rules that are being filed to determine the book tax adjustments as well as tax effects. And the total up, that's the contribution of the elimination of the P entity to the consolidated book. That's really a mouthful, but really, if we go back to the output summary, we see that for the whole group, that's the total effect, journal entry. And at the individual level, here's a contribution from from CH1, and here's a contribution from P. And those values are really from the individual calculation, the provision calculation for each individual entities. Therefore, in this case, we see that the engine automatically determines if you move around your inventory within the group, those transactions would be eliminated. But their tax effects, it's not simply removed from the consolidated book. Their tax effects are such that if you incur tax expense because of you move inventory around within the group, those tax effects would be reclassed into deferred tax accounts. So therefore, they will not impact the income statement of the consolidated book. Now, what about, let's say, the CH1 in the subsequent quarter sold those inventories to a third party? How would the engine handle that? So let's take a look. So we're going to close the output file, and we go back to our input file. And for the next quarter, the entries would be different. So let's make some entries to reflect the fact that CH1 is actually selling the inventory out of the group. So here are the journal entries for CH1 selling inventory to a third party. It bought the inventory at 150. Now it's selling for 170. So here are the journal entries on CH1's book. And on P's book, is really no effect at all. Okay. Now, because the inventory had gone through the intercompany transactions, and that now inventory is now completely out of the group, the elimination entry is such that it needs to undo the previous quarter's eliminations. Okay, so so let's see what those elimination entries would be. Now, here is the elimination entry for the fact that the CH1 is selling those inventory to a third party outside the group. Now, let's look at it. Because the inventory now is out, the original elimination entry is now reversed. The cash is minus 50. The cash was positive 50. So it is reversing the elimination entry of the prior quarters. And the same thing happened on the parent's book as well. And these are to reverse the original elimination entries. So these are actually undo the elimination, which effectively is redo the very original transaction on the P's book. So it's a little bit of, your inventory is gone, but you have to remember, you have to undo your prior quarter's intercompany elimination. So on this elimination entries, it is either to eliminate your original transaction, or it is to undo your elimination. So this elimination is to undo your original transaction, or the elimination is to undo your elimination. Finally, for this quarter, the original transaction is not really there, so we are going to comment out those lines so that these numbers will only be referenced to compare what happens to the elimination field in this quarter when the inventory was actually sold to a third party. So those previous quarters entry are all commented out, and the engine will never see them. And to emphasize once again, those elimination entries, the elimination entries over here for tax calculation purposes, for tax consolidation purposes, they are to undo the intercompany transactions. Now, when the inventory is actually sold out, any prior quarter's elimination entries needs to be reversed in this quarter when the inventory is sold out of the group. So that's it. Let's see what happens, and we're going to save it. And we're going to submit it and see how the engine would handle the tax effects of the elimination entries. So it is down. Let's open the output file. Now here it is. It is the number is different from the previous one, and we're going to focus on the elimination. Okay. And the tax effects, again, it is moving around. The previous is to move the CTE and DTA into the deferred taxes accounts. Now it's the other way around. It is undo the previous elimination entries, and tax effects on the consolidated book is the reverse of the earlier quarters. And again, those numbers are from individual single provision calculation. Every single account is being analyzed by the engine, going through the book to tax adjustments, and then going through the tax effects calculation. And they are all summed together and rolled up into at the group level. And what exactly the rule that's applied is also indicated in the output file. And this is for the parent and for the child. It is over here in all the accounts, and book to tax adjustments for the elimination entries and the tax effects and the actual rule that's being applied. So now to summarize, since the B2T engine cannot really tell whether a transaction is intercompany or not, the elimination calculation relies on the user entering the correct elimination entries for each account of each entity. The elimination entry is to undo the intercompany transactions, or it is to undo the elimination entries of prior periods when, say, an internally transferred inventory is finally sold to a customer outside the group. As long as the user maps his accounts to the standard accounts, the engine will automatically apply the relevant rates and rules on those elimination entries to calculate their tax effects on the consolidated book of the group. That's it. Thanks for watching.